SBA EIDL Loan Increase versus business lines of credit, how you can get a revolving line, use the money as you choose, only use what you would like to, and then get it back put into your account to use time and time again while helping you with interest rates, perhaps terms, and so much more than just getting a lump sum. I'm going to cover the similarities and differences. Before I do that, my name is Michael with Viral Funding Solutions, and I come out with content like this on all idle lines of credits, other working capital lump sums, equipment financing, real estate financing, personal loans, startup loans, building business credits. The list goes on and on. You get the point. And I've helped out a lot of businesses acquire funding over the time, getting them to understand the education that you must have before you walk into an application. So you know with 110% confidence and certainty, without a shadow of a doubt, what's happening and what you could possibly get approved for without making mistakes after mistakes over time. So I'm going to jump right into it. No further introduction. I apologize if it is a little dark. I'm using this new HP laptop with this lighting screen that goes dark and light sometimes. So I'll have to figure it out. And what I want to start with saying is that the EIDL loans right now are exhausted, quote unquote, meaning that the funds are not being dispersed of what is there. And so if you're wondering, can I get started in a new application? No. And then secondly, if you're in the queue getting processed, that's not as open at this moment right now in terms of you getting funding or perhaps getting answers in return. Perhaps you've received an email, which could be happening right now, saying that you've been declined. But if not, then that's just the circumstances. And in time, I will let you know and keep you up to date. And you may be watching this later on where it has opened up. There's no projection on that. Well, you should understand that the EIDL, you get a lump sum over the time. You know, you see these 30-year terms. And with a line of credit, that's exactly what it is. Think about it like a credit card, but you get a revolving line that you can keep your payments low if you pay it off faster while it being a revolving line. So let's say you get approved for 150,000, you don't need to use all that 150K at once. You need it only for a season or something's happening. You may need it all at once. But I say I want to take out 10,000 to use. I'm only going to pay interest on that 10K, the principal and the interest, a withdrawal fee for however much time I have. So I may be given 6, 9, 12, or 18 months. That's usually what you see. 18 months can be a little bit pushed out for more quote unquote rare circumstances or perhaps collateralized. But what you have to understand is, as opposed to the EIDL giving you a line of credit, and there are SBA loans like the cap line program underneath the 7A that can help you get a line of credit. And then there's also a lump sum. And I've created content on an alternative to the EIDL, which is the SBA 7A, a product with a 90% approval with the fastest, simplest, and easiest SBA process out there on the market today. Really new stuff that works very well. But you have to understand that those other SBA options, should not be used primarily just for relief. I need to pay off a lot of debt. Could be a part of it, but a primary use should be for growth and expansion. So that brings me into my next point. So you have a line of credit you can withdraw, becomes a revolving line, and then you have the EIDL loan, which is more of a lump sum, deferments. You know, the repayment period here is coming up in October, so be ready for that. But the difference is that you have a lump sum and you have a line of credit that you can withdraw and use. Now, the terms, you may be getting 30 years here, for profit, nonprofits, the different. And then over here, you're getting usually 6, 9, 12, 18 months. So it's kind of more one of those shorter term frames. But that doesn't make it any less than getting an EIDL loan. The same thing can be applied. Like if you got this for COVID relief, which is primarily what it's for EIDL, over here, the line of credit could be used for COVID relief too. A part of it could be business and growth. Every lender always wants to see projections, what you're doing now, what could have been happening in the history that determines what's happening now, or perhaps in the present. And they want to lend you on growth and expansion, building it. But you can also get funding on, I have relief, I need to make payroll, I have to pay my rent, I have to do these with this expense and business operations. Yes, but also you have to understand when you go to a private lender, they want to see some kind of growth or expansion. What are you using this funding for as well? But it can be used in a similar sense. COVID relief, business operation, similar circumstances, but just understand that this side, it's a shorter term. This one, it's a longer, but a lump sum, not a lump sum. And so that's the biggest difference. The interest rates. Now, when you're looking at COVID EIDL loans, that very, very low percentage that you've been given on like that 3.75% or so. Over here, a line of credit can vary in how it's amortized, and every lender is different and they have a different set of underwriting. So I won't go so in depth into underwriting now, but you're looking at about 1 to 3% per month is what you'll get in an interest rate for 6, 9, 12, or 18 months. Ideally, most people want 12 months. That's what most people want to shoot for, even though they don't need that much time or that many weeks. But it will keep your payments lower. So let's say you took out 30,000, you're paying it over those 12 months, those weeks, how it's amortized or on a monthly repayment. And so to keep your payments lower, you want to make sure you pay it off as soon as possible and put it back into your account. So the interest isn't accruing over time. And if you took out more from your line of credit, that principal plus interest with the withdrawal fee on top of what you already are still currently paying is going to be added on top of it. And we can readjust the calculations on what it would cost. So just understand that those are the differences. But 1 to 3% with a line of credit is what you can see usually. So if you were given 6 months in a line of credit assessed on your risk, because you probably went backwards with credit. You have maybe liens, something's happening that hasn't been removed, some circumstances where you're building up too much debt, your debt to income ratio is way too high, credit utilization, inquiries, you have so many in the last 3 to 6 or so months, and then you're just stacking on again more debt, and your late payments and credit utilization ratio is just too high. So those are factors that come into approving you for a line of credit on top of a little bit more on your consumer credit bureaus with personal credit. But we also like to have business credit established. So you can see with a line of credit, business credit established, it's important to have some trade lines built, accounts underneath it. And if you need help building your business credit, what I recommend doing is looking in the description. I may have this free building business credit video series I'll link you to. Get started in there. I have a few videos that I created and then what I did to move forward in building my business credit and how you can do it yourself. And then at a point, if you want to learn about more about credit cards and what's available, you can go for that as well. And there's also a credit line hybrid program where you can get 0% interest for 6 to 18 months. And this is a credit card stacking program. But if you're looking for 0% interest and you have high consumer credit, then that's one to look for. And I'll leave more information down below. And I'll jump into the share screen in a moment to go over some of these options. But 1 to 3% interest, you can see already if you were given 9 months, or let's say 12 months for this example, at 1%. And to get that 1%, it's a factor of how well is your credit reports? How well is that number? Is it fluctuating? Is it stable? What is it reporting in your credit? How much debt? Late payments, if anything, credit utilization. What are you stacking? What do you have here? What's reported in the past? So there's a little bit more of an extensive look when we're looking at a line of credit than always as opposed to what you're getting over here with the EIDL loan. So that's what you have to consider when getting approved for one. So even if you got 2%, 12 by 2, 24%, relatively low. I know it's getting a little bit higher, but again, you have to think about what you're using these funds for. Always understand the benefit has to exceed your repayments. And if it never does, then it doesn't make sense for you to move forward. And the repayment will be up here or maybe right there. And it's in a threshold where now you're unsure if you're going to even benefit in the next month or two, if you're going to increase your ROI. So understand your return on your investment in the short and or long term all the time and what you're using this money for. If it's just survival money, how's your cash flow? Do you have enough reserves? Do you need more cash flows as part of what you're looking for? Do you have more inventory, marketing, advertising? And so there are multiple uses over here as opposed to just COVID EIDL loan, which was meant for those hard-hit industries and areas and businesses that were suffering. They had to partially, fully shut down, gross receipt reductions, losing people on their payroll, a lot of different things happening here, and then a bit of a difference in similarity in the sense here. So what I want to do for you is jump onto the share screen and show you a few of these things. So as you can see here, SBA EIDL Loan Increase versus business line of credit. And I more or less went through the plus 0% interest for 6 to 18 months and up to 150,000 plus. is what you can look forward to, plus funding tips. So I'll link you to more of that program down below in the description, and also pick up the business credit building video series for free. It's no cost at all. Just put your time and energy a little bit out of your day, and it'll be well worth it in the future. So over here, I put a few options. This may look a little bit familiar if you're filling out my questionnaire form, which is this one that I talked about in the beginning. And you can get a complete personalized and customized email response for your best funding option and options. Plus get a free 6-step approval lending checklist to get you approved for funding much faster. So I'll ask for things like name, email, phone number, mobile preferred. I do this so when I get the email, I evaluate, analyze, and then I'll give you a proper response back via email most of the time. And then I'll follow up with you via text saying, hey, this is me. I just sent you an email. Please look for the email with the subject line. This and this and this is what I put together. So you can refer to it. Sometimes it lands in the spam box the first time. So just be aware of that. Funding amount, and make sure you look in every folder if need be. Funding amount that you're requesting. What's your time in business? Please specify by years or months. FICO credit score. I'm not a creditor. This is very safe and secure information. This is for me to get an understanding of the underwriting. Like, okay, if you qualify for this service, what ballpark in our underwriting would you look, more or less at getting? And do you have A, B, C, D plus tier lending material? Which kind of lender would like to look at you versus another one? So we're not wasting our energy and time. Do you have established business credit? Very important. The biggest difference between you qualifying for an SBA loan, for a line of credit, is having established business credit. It's not just saying I have put up my Dun & Bradstreet account and I just left it there. No, do you have multiple accounts, mortgages, insurance, other things under there? Business loans perhaps already existing? And do you have trade lines built underneath all this? And how many trade lines? Are you continuing to use business credit? Lowest monthly revenue in your last 3 months? Average monthly revenue? Your average daily bank balance? Very important. Once we get to this part, guys, yes, there's a little bit of, hey, just input a little bit of numbers and it's very safe and secure. Be honest with me. You can even give me an estimate. If you're not looking at your bank statements, I don't expect you to go there, profitability or something like that. Balance sheets, year-to-date financials, profit and loss. What I just want is, hey, do you have, like, if you can be a little bit more precise, the better. That way I can help you get a ballpark range. I can even give you some numbers before we go into the application, but it's not always set in stone. We still have to go through it and get a better analytical assessment and underwriting, see what the bank statements and all this stuff that's being asked for is giving us back. So average monthly revenue, average daily bank balance are very important. If you have just a few thousand, and this goes for like a line of credit as well. So if you only have a few, like you're barely above 1,000 minimum, you're depositing 40,000 and you're only making 30,000 in average monthly revenue, like 1,000 in average daily bank balance, we can't afford to give you a high enough amount of funding. And two, it won't be able to demonstrate you can repay it back. So we can't have repayability be too high for you, or we won't be able to approve you for just meeting the minimum. And then we have to factor in insufficient funds, non-sufficient funds, negative bank days, chargebacks, overdrafts, and quite a bit more. So just keep that in the back of your mind as we're going through all of this, and I'll explain it to you. So annual gross revenue, highest monthly sales in the last 6 months. You can estimate it if need be. Sometimes we don't know this. We just have to take another look to be precise if you'd like. But what I prefer is just give me an estimate. You're already here. You may go back. You might not even come back to this. Highest monthly sales in the last 6 months, average monthly gross sales in the last 6 months. So similar sense, but I want to get an average now. If need be, just give me the estimates. And that's what I would, like to see. I'm not asking for a lot. Just make sure you have that information there, and it helps because some services we're looking at 6+ months in bank statements, others are 3 months, and in those 6 months we need to see what your average monthly sales are within those last 6 or 3 months, and then sometimes we look at the highest month, and so it makes for a better experience for you and myself when this information is given. And then use of funds, purchasing existing business, COVID expansion, you can select from any of them. Existing business loan advance, yes or no. Business industry, I would be very happy if you put this in there. Please do. Business name, any additional notes. And this a lot of the times can be required because I want to know if your expansion project, what is it exactly? Like, be as specific. You don't have to be 100%, but if you can, do it. And that can avoid always being on a phone call. So you can give me more information. At times it makes sense to get on a phone call to hear from you what exactly it is you're trying to do. In other cases, it doesn't. A lot of the times we can do this through email, text. A lot of people who do millions for millions just do it this way, and they trust me very well. And I hope I build that trust with you in time, if not already. But make sure you put that information there. It'll look like that more or less. This could be updated over time. I keep doing it in circumstances, so maybe some things are added, maybe some things are left out. But those are the expectations. So business line of credit, and I'll show you in that questionnaire similar to this is what it will look like. And there might be some numbers, there may be some additional stuff, but it's personalized and customized to you. There may be some underwriting, there may not be, because sometimes we have multiple lenders, or sometimes we have one direct lender, and so sometimes we have to just put it the way it needs to be put, and it can be explained a little bit later. So business line of credit, this one option is up to 150K, and usually you get between 50 to 150% of your average monthly sales. Okay, you can use the funds however you like and use as much as you want. This is a perfect way to utilize for all types of fundings. Here are some details: credit lines of 5 to 100,000 and draw from at your convenience. Automatic weekly repayments for this specific one, easy to understand. There's kind of some examples here where I go in through. I'm going to skip some of this stuff, but no prepayment, no collateral is required. You can lower your weekly payments by drawing out more. Longer terms can keep your payment down. Balance fee is anywhere around 1% per week. This is for this specific one of these lenders. So for every week you have it open, you are charged a 1% fee on the remaining balance, and it can be as low as 0.69%, and it can be as high as 1.39% per week. How this is an amortized weekly schedule. Withdrawal fees can be anywhere from 0 to 3%. So there's always a very common withdrawal fee of 0 to 3% you're going to see in a lot of these cases. But whenever you take out more, there's a little withdrawal fee on top of that. So depending on your file, if you are in for the long term and want small monthly fees instead, and so forth. So we can also do it. This is kind of like a bridge. This is kind of like bridge money. If you're in fix and flips, you kind of understand this already. This is what like a line of credit can be used as. But if you're looking for a longer term, there may be just some small monthly fees where we say, hey, you want this long term, we can work with that. And some other lenders may not give you that access. And especially in today's market, I may not be as open to doing that. So just keep that in mind. 0.69 to 1.39% here. Interest, cost of funds is what you're looking for. This is how it's amortized on a weekly schedule. And there's monthly ones too, so stick with me. For example, let's say you get approved for 20,000 and withdraw the minimum of 1,000 with a 3% draw fee with 1,300, then divided that by the amount of time in terms you got, which is 6, 9, or 12 months. Depends on what you get approved for, and it's based upon your credit factors, your industry. It could be parts of it being revenue as well, because that is a factor. A lot of the times you can get in with 10,000 per month, 120,000 annual gross sales. Other cases it's 15,000 or 20 or 30,000. So just know that, and even at the lowest, it doesn't necessarily mean you're going to get the best. So with higher revenue, it also gives you a lot more room to get approved for more. So the higher in revenue you do, the better you get. As you see, you can get approved between 50 to 150% on your average daily sales, on your average monthly sales, I should say, excuse me. And then divided by 6, 9, or 12 months, depends on what you get. So we divide that 1,300 into the weeks within the months that you were approved for. So let's say it's the 12 months, which is ideally what most people would like, and it's 52 weeks, then that's $25 plus the cost of the capital, which is the interest here. If 0.69 is what you receive, then you pay $94 per week. Now, I don't want to confuse you with too much of this, but I got these numbers from taking the principal of 1,000 with your draw of a 3% fee, which you owe $1,300 right there on your balance, just from that alone. Then I divided that by the 52 weeks, excuse me, here, because you got 12 months, and then figured out your interest or cost of capital to be 0.69, which is a number given to you based on the assessment of your risk profile, your average daily bank balances, revenue, credit even being where it needs to be, if it's strong enough, the reports. I'll get into some of that in a moment. Because you got those 12 months and then figured out your interest or cost of capital, like I just said, this number is given to you. So 1,300 divided by the 52 weeks equals the $25 that I said earlier, plus the 0.69% in the interest, multiplied by 100, which is the $25 plus the $69, and that comes out to be the 94 you'll be paying until you fully used up the principal of the 1,000 you took out, right? Without the 1,300, the only thing in the principal is the 1,000 that you took out. And so that's what you're looking at. I hope that makes sense. It can sound a bit confusing, but it's very straightforward. It's an amortization thing, which is a jargon for your weekly payments and how they get calculated. There's a bit more on that. So qualifications for this one, we're looking at 15,000 plus in monthly revenue, 550 plus owner, FICO credit score, 1+ year in business, possible disqualifications. And what I want to make mention of is, yeah, you may have a guarantor, you might have another business owner, and just get that understanding in there. So 1+ year in business is what we're looking for. Possible disqualifications, high debt to income ratio, and that could be way above, 40, 43% and above, even in the 30s in a lot of cases. So keep it very low, pay off what you can, pay those credit cards off. And if this is what primarily you're getting it for, I mean, and you have too high of a debt and you're servicing over 50% of the funds you're going to use for that, it could be quite difficult to approve for. And just think about, how fast will you be able to pay that off? And so always have more uses, the better. That way, when you come to the lender, you say, I have some debt I want to clear, I have some consolidation, or I have this expansion growth project, and this will be what I'll be using it for. So I can keep my payments and I can have proper cash flow, excuse me, more so in time than I have maybe right at this moment. And it helps. Too many inquiries, history of late payments, don't have any of those late 30-day payments. You have net 30s, net 60s, net 45s, net 90s. Even without that, just be careful about you taking on too much that you can't even make the payments on. You're paying your bills on time, can't even make your rent. It's just very difficult. And then credit utilization ratio is too high. So try to keep it at a minimum. Below 30% is what I would say. Some would say 35, but even less than 20%. Have none of that. Just clear it up, which is great. And I have a lot of people who come to me to this day who don't even have debt. Like, it's kind of hard to believe. And those who have been in business for a long time will understand it better, how to get themselves out of debt, why not to afford this type of debt. It's usually individuals who haven't built like 2+ or 5+ years in business that understand that completely, and they're taking on a lot of debt, especially if you're just starting. And it's not open to starters, just so you know. And if you are looking for a line of credit or a credit line hybrid program for startups and non-startups, then that credit line hybrid I recommended you guys to earlier, look down below, but it is based more off credit. So just look at that. You have an existing line of credit already. Probably you already have one with the bank, or you're already on a monthly, you're expecting us to come in a monthly position, or on a weekly, on a daily. That may not be the case if you're already taking on lines of credit to exist with. And it can be a bit difficult to be approved for, especially if you have like term loans or cash advances on daily, weekly, even on more so cash advances daily, weekly. You want us to come in on a line of credit. We could, because they're not directly correlated. But if you're over leveraging, if you have too many positions, which means too many loans open, and you're trying to get a line of credit, you're probably over leveraged. We can't help you take on more debts on top of not even paying enough of the balance on this, over 50% of it. So you got to have a strategic roadmap and a strategic partnership. And I came out with content on this recently that I'll link you guys to down below. View that video. I know it's a bit intensive in terms of time, but it'll break down like why you are not doing this right, why you're just going to every possible option, you're not doing it correctly, or this direct lender versus going through this brokerage who has these direct lenders with these partnerships that I have. It's better to do it one way versus the other and a lot of times. And so make sure you check that out so you're not getting frustrated. No, if you'd like to get a line of credit, this is the cool part. We can also evaluate you for a term loan so we can get both, thus giving you more funds, maximizing. Or you can take one if you choose, if it's only one you're looking for. I'll show you the term loan option after these, and I'll give you a little bit more information on that some other time. And I have other content on it that I talked about with the EIDL loan versus unsecured term loans. I have EIDL loan versus SBA loans, EIDL loan versus cash advances, private loans, etc. If I didn't say that earlier, I'll link to you those down below in the description. This is a big series that I've been making a part of this, and a lot of people would love hearing this. So that's what you would like. That's an option we can do. You want to go through the app sequence, you might select both, or we can go ahead and get connected with you, and we can ask you, okay, is this what you want? We can look at giving you an approval for more things than just one if it works out. Documents that we would need for this: 3 months of bank statements, a voided check, a copy of your driver's license. Very minimal, right? It's very less intensive documentation. Low doc. It's not no doc. That credit line hybrid, it is no doc. If you want to check it out, you can even pair that up with one of these and it will work out for you very well. You will be able to safely and securely upload your documents needed online with our streamlined and hassle-free application process, and we get them in our backend. So make sure you have them all together. Sorry, I'm getting notifications. Make sure you have it all together before for making a faster process. Otherwise, you can save it and continue later. So just make sure you have your documents, you have your drive, wherever you put your bank statements, your pictures of your driver's license, copy of it, voided check with the words void across it. And if we have to look at multiple business bank accounts, we will do that. If you have multiple ones, like I deal with that every single time, where somebody may have one with Truist, somebody has one with Chase, Wells Fargo, and we have to look at the last 3 months of those each and see what's happening. And that's okay. We just have to get a better assessment of it. Now, application, you may be able to click a link there and it'll take you so we can do it online and we can see it in our back portal in our office, or you can send them to me directly. Either way, then I can forward them over to the lender, get them through underwriting. Either way works. We can just go ahead and see them on our back end, and that'll be another option. There may be moments where I do ask for it from you, and there'll be other moments where I give you that option, whatever you feel is most comfortable, and especially if you want to look at it beforehand. And so when you click that link above, you go to this tab and it'll give you a little more information, and I'll probably give you like some review videos. So make sure you check that out, as well as like blog post content on it. Option 2, line of credit. This may be best for you. I may even put it in parentheses and I'll explain to it why. I also have another program where we can get you up to 250,000 in the line of credit without having to put up collateral as well. And so there's one with 100, there's one with 250,000. There may be one with 150,000 or even more if you're offering up collateral past 250K. That's what you have to understand. Over 250K, a lot of the times, do you have collateral? Usually we want to take accounts receivables, which is unpaid invoices, is what we would like to primarily look at. Now, if you're going through the SBA cap line program, it may be a bit different. In the same sense, they'll look at it. But that's what we like to see. Sometimes it may be real estate equipment, but in most parts, you're going to see accounts receivables, unpaid invoices. Now, this may be your best option. I'll probably label it for you if it makes sense for you to get approved over 100,000. You're looking for that amount. If there's no point of getting approved for over 100,000, it may be a different lender, or maybe a different place to go to, or maybe the same one. But just understand that there are differences and there are different things you can look at. 1 year time in business, 25,000 deposited monthly into your business bank account, or 300,000 in annual sales, and have a 600 minimum FICO. And that number tends to change a little bit, but 600, sometimes you see 650, 660, but 600, ideally you want to have stronger credit. From what I see in the 600s to about 680 a lot of times, and even underneath that, even far worse, is you're juggling a lot of debt. You're juggling a lot of inquiries. You're taking on too much. You're flipping back and forth. You did this with a family member. You did this in your business to affect your personal credit, perhaps your business credit. Something else is happening. You're working on it there and it's fluctuating. So usually what you want to see is higher credit, especially in today's market and just about every industry I talk to. And if you're even in a higher risk industry like trucking, if you're meeting just the minimum of doing 15,000, 25,000, just 300,000 in annual sales, like that's hard to get approved. Just a minimum of 600. Yeah, there's approvals, but we want to see strong revenue. We don't want to see a lot of fluctuation, especially in a lot of different industries as well. It's not the only one it applies to. More details, like I said earlier, unsecured lines of credit are 1 to 3% per month. So 12 by 2, 12 by 3, 36. It's assessment of your risk. And I'll get into that more in a second. Unsecured lines of credits are either daily, weekly, or a monthly repayment. So secured lines of credit against receivables, rates are prime, which you see today in 5.5%. That number can be going up within the next 2 or so months, perhaps. So I'll let you know. Sometimes I forget to adjust it, but you should just know it's prime rates plus 2 to 8%. Some other products are plus 2.75, which you see with the SBA loans, 7A loans. You can see like a prime rate of 5.5 plus 2.75%. So at most on a fix, you're looking at 9.5% or so. And variables, you're looking at a little bit maybe higher, more or less. So some of those numbers are assessed on cash flow with the SBA 7A program is primarily what they look at. I don't want to get too ahead of myself, but just know if you're looking for an SBA 7A loan, I'll leave more content down below. And the primary thing that we look at is cash flow. That's why year-to-date financials, profit and loss, having at least 3 years, sometimes 2 years of federal tax returns, personal tax returns, bank statements for the last year, and then the most recent 6 or so months, which is what we're asking a lot of time now for a lot of risk factors. And we have to assess cash flow. How is it doing? What gaps do you have necessarily? What's happening in these quarters by quarter to quarter basis? And then some of the other details that come into play, secondary, could be liquidity and then equity injections. And then we look at collateral could be the last thing to look at. If you had it, it's sufficient enough. But you have these other things we can look at. What do you have in your bank? We can withdraw from if necessary. Maybe add something as a down payment of 10% on those, or how much collateral do you have in equity invested, liquidity, how much cash do you have on hand, etc. What assets are attainable. So collateral isn't the number one always way. Invoices. So unpaid invoices, accounts receivable is a method that the SBA likes to look at when we look at collateral first, and then it's possibly real estate, equipment, and so forth. But I'm getting too far ahead of myself. I have content on that down. So plus 2 to 8% typically. Approvals for lines of credits are typically 100% of your monthly sales, and as much as 150% or so, depending on factors such as your credit score, industry type, and in business, debt, etc. And it can go as low as less than 50% of 100. So 50% to 100% or 100 to 150%. Excuse me, it just depends on these factors and more. Average daily bank balances, excuse me, and what you're keeping into your account. Are you keeping more than what you're withdrawing on a month-to-month basis? So average monthly sales is a factor, average monthly revenue is, what's your highest amount? Are you projecting up? You can take the highest and then see what the average is in those 3 months, but you have a very recent month where you're high. Like let's say you did 100,000 the last 3 months, then you did in the middle of that, you did 120, then you did 200,000. So if we took those last 3 months and averaged it, or we looked at the last 6 months, a lot of the times we look at 6 months because you're asking for a lot more. So some lenders want to see more. So we average those 6 months instead, and then go, what is the recent 3 months? And say, what's the highest? Is it the most recent that you had the highest? And we can look at that average and the highest and say, hey, you can base it off this value and go up. It just depends on each case. So that's what you'll see approvals for and some of the things we look at. Options, number 2, line of credit continued, it's the same one. Here are the benefits to this unsecured line of credit. Same day funding available. Only pay for what you use, up to 250 line of credit without it being collateralized. You want collateralized funding, then I have some of those options. True revolver, each payment frees up additional available funds. Qualifications, 1 year time in business, 25,000 deposited monthly in the business bank account, or 300,000 in annual sales, a 600 minimum FICO. Plus, note we can evaluate you for both line of credit and unsecured finance and term loan if you want, and or a cash advance. And then just think about this. These things can maybe later evolve into an SBA loan where then you're now consolidating or you're keeping those options open. And then you have everything underneath one. And it's stretching out your cash flow where it's much better over an extended amount of time. So option 3, secure line of credit backed by accounts receivable collateral, streamlined transparent process, 2-day decisions, accelerated closing, up to 95% advance rate, no industry restrictions, validity and personal guarantees offered. There is no set payment. You will pay upfront fees to set up the LLC, and then you pay the rate when the money is collected, which is normally within the 30 to 90 days, talking about those kind of terms. Qualifications, 250K in aging accounts receivables, or have 100 or a million, excuse me, in inventory. There's no minimum FICO because it's based off of assets, and it's usually based off of your customer who you're receiving the unpaid invoice from, who they're checking, the invoice factoring company's checking. No minimum time in business. Facility size, let's see here, 250K to 25 million plus 12 to 24-month term. So that's where you get into a little bit longer. Rates start at prime plus. So application, you maybe want to get there. Then there's some additional notes. Accounts receivable financing, I also help you with those to get an AR line of credit. And that's where you're giving up unpaid invoices to an invoice factoring company. What do you need to qualify? 6+ months of business. A lot of the times it's 1+ years. And having just 6+ months, you have to have like strong enough revenue as well to justify it and meet those qualifications, which are 40,000 in monthly receivables and or 100,000 in open receivables on 30 to 60-day terms. And then 1 million in annual sales is what we would like to see. No minimum credit score. So we'll also evaluate aging and non-aging receivables and factor that in. Aging really does help a lot. Benefits, seller wants several invoices, get funded immediately, manage cash flow gaps, revolving line of credit, similar as what we talked about. Facility size, 250,000 to no cap. Line of credit amount fluctuates as the AR fluctuates, either up or down, and then the market, we have to take that into consideration. Rates starting at prime, 5.5 plus 2%. So you can see how it's less than getting approved for some of these other options that are 2.75 in some cases, and then you see 2 to 8% uncollateralized. So the rates can get into high single-digit teen rates, depends on the industry and the markets and what has to be readjusted. 4 to 7 days application to funding, so it's really quickly. And that's a bit of a difference with an EIDL loan. It might not be as quick. It could be a little bit more extensive with like the 4506T forms and all the stuff that's happening. So you may not be receiving your funds right away. It's government funding. And other SBA options may be the same thing where you're waiting 6 to 8 weeks plus to receive funding, 1 to 3+ months out. So more details, funding amount, 10,000 to 5 million, flexible term, 6 months to 10 years. We can potentially end up to 95% of your aging. Sorry, I put it again. Aging receivables, documents that are needed for you to get started. 6, completed application. There's a digital one I'll link you to. And then we may be looking for um, a PDF version. I may send you, may not send it to you, but digital, you can just get started. You can even upload stuff there. We can see it on our backend or send them to me. And then do a few things. They're moving out. Completed application, 6 months of recent bank statements, most recent business tax return. And just keep in mind, if you're like in agriculture, we might have to look at 12 months in a different industry just to assess because seasonality things come up. So we have to stretch it out. So most recent business tax return, 2021 and year-to-date balance sheet and income statement. And that's correlated to the year we're looking at. So if we're in 2023, 2022 or 2021, they may still need to look a little bit back there, but it's correlated to the year. Aging AR report, sometimes AP reports, but you're saying aging AR report to get an assessment. Those bank statements help us understand your cash flow, understand your depositing, your patterns, understanding the aging AR report, what that reflects. It's a huge combination. Applying, there may be some links there. Now, there's also inventory financing. And then the benefits of that, you get a revolving line of credit similar to what we were seeing this whole time. Facility size, 250,000 to no cap. So it's extended tremendously there. Line of credit amount fluctuates as inventory fluctuates up and down. And I see a lot of that in today's market. Like a lot of people are trying to get their shelves stocked. A lot of them are releasing a lot as fast, so they need more as they go, and it goes out and it wipes out. A lot of it just sits there. So rates starting at prime plus 2%, so similar. You get up to 85%, so a bit less for the inventory financing as opposed to the accounts receivable in the other sense. On inventory liquidation value, that's what we're going to look at. So it's kind of like an appraisal in a sense, but we have to understand the inventory liquidation value. 7 to 14 days application to funding, so it's a little bit further out. Qualifications, but still rather quick. 1 million in current inventory, as I said, and this might be something I tell you guys, but in the questionnaire, so I'll just blank this out. So that might be an addition. So when it's customized, I'll give you guys some things. I might even give you guys some numbers. It may not even be there all the time. In other ones, it will. So 1 million in current inventory, 1 million in annual sales, 1 year time in business at least, no minimum FICO, backed up by assets, collateral, inventory, home equity line of credit. Then there's those options. You can take on a second mortgage, lets you borrow against the value of your home. You essentially tap into some of your equity in your home as needed, and you pay back only what you borrow. HELOCs are usually used to finance home improvement projects, education expenses, or debt consolidation, but you can also use it to kickstart your business or keep it driving forward. I know a lot of this. I have family members, friends who do this all the time, and a lot of individuals will go down this route, especially if you don't qualify for the others. If you don't have those other qualifications for those lines of credit, it may not be there. So you have to say, hey, would a line of credit for my home? Would it be something I get in a lump sum of equity, or would it be something I'm paying on installments or revolving amounts? Or how is this going to be amortized over time? So you only want to take out what you know you'll be able to pay back. It's very important with that, with the home equity line of credit. Then there might be options like, online bank term loan options, and quite a bit more, but I'm going to just leave it at that. I hope you got a lot of value from this video. Let me see. I want to make sure I didn't miss anything. There's also a video I made on this on the hybrid SBA 7A loan. If you're looking for SBA financing through the 7A on what our qualifications are, some of the stuff has changed because of the market, but it's more or less what you're seeing there on the screen. And yeah, I just covered it right there. I'll even cover it with you, your options, what's best and what's not best, where to get started, how to get going. And make sure you get started on this questionnaire down below. Just to recap, similarities and differences, lump sum, not a lump sum. Interest rates can be relatively low on kind of the two in a sense, but a bit higher, 3.75, you might get 12, 18, 24. Unsecured finance, you could be getting up quite a bit less if it was backed up by collateral, perhaps. And you see that with the prime rates plus 2 or so percent that we went over. Relief as well can be your primary, can be also secondary, but we also want to see some kind of growth and expansion that it's being used for. I mean, just have that in mind because we need to be able to service. You need to be able to service the debt at the end of the day, and if you're not being able to make those repayments on what you're using that money for, it's just going to be a whole lot of trouble. So cash flow is very important. What we look at, credits, cash flow, collateral can be a factor. Could be here, could be not. But those are just some of the things. There are many more, I know that, but I'm gonna keep it at that. And no prepayment penalties. I could say some of the things there. Deferments may not be allowed, depending on how strong enough of a relationship you have with someone. And we can go a little bit further out there So EIDL loans shouldn't directly correlate to affecting what you get approved for an unsecured line of credit over here with private lenders and so forth. So it's a bit different, separate from an SBA 7A. So it shouldn't primarily affect that. So hopefully you got a lot of value out of this video. Check out my #1 recommended places to go to down below. And if not, just go through the questionnaire if you haven't already. And if you have, I'll get back to you. I get a lot of submissions. I'm flooded. And so please be patient with me. I'll get you that information back. And if you send me email after emails, I will do so. Appointments, I will attend them. And sometimes I can't attend them. And it goes so fast that I apologize if I didn't respond back and saying sorry that I didn't let you know ahead of time. A lot of times I will. I'll let you know, hey, I can't make this. But get all the information down below, get it from an expert, get the right strategic roadmap and partnership, and you'll be well on your way. So that's all from me. Talk to you soon. Oh, one more thing. Sorry. If you haven't liked this video, I'd greatly appreciate it if you did. Share with others who you feel will get value out of it. It can be a complete stranger, friend, or a family member, but you know that at the end of the day, they were able to rest their head on their pillow and yourself as well. And having the right conscience in your mind, thinking, hey, I helped somebody out, whether I knew them or not, they can go to bed easily. They can wake up feeling more refreshed, getting the funding, the education first, and then the funding second. And if you haven't subscribed, please go ahead and do so and click that bell notification icon so you do not miss any future videos I come out with. That's all for now. Bye.